Today is Saturday, December 20th, 2025. Just as many of you were settling in to enjoy the weekend, the market decided to play a cruel joke on us. And what's the most stunning piece of data today? It's not how much retail panicked, but the fact that Wall Street's smart money is voting with its feet, staging a quiet but systematic exit. The latest data we've received shows that just yesterday, Bitcoin spot ETFs recorded another massive net outflow of $158 million. This marks the second consecutive trading day of large-scale capital flight. Friends, remember this number, negative 158 million. An amount like that could trigger a financial storm in many smaller countries. So, here's the critical question. While retail traders see a minor price bounce and think the crisis is over, why is the most min-ray institutional capital accelerating its exit? Is this the final brutal shakeout before the bull market ignites? Or is it a clear signal that a new downtrend is beginning? In today's video, we'll use the Wyckoff method and a macro perspective to break it all down, layer by layer. Alright, let's cut to the chase and get straight to the data. Please take a look at our first chart. Fear and Greed Index showing 27. Dimension 1. Market Sentiment. Today, the Fear and Greed Index stands at 27. While that's a slight recovery from yesterday's 21, moving sentiment from extreme fear back to just fear, I want you to pay close attention to my wording. It's merely an easing of fear. What does this tell us? It shows that after the sell-off in recent days, there has been no powerful restoration of confidence. In a downtrend, this kind of weak emotional bounce is often a bull trap engineered by whales to distribute their holdings. Retail sees a small pump and assumes the bottom is in, but the flow of smart money tells a completely different story. Dimension 2. Institutional and on-chain flows. This is the core of our analysis today and the key evidence I mentioned at the start. 2 consecutive days of net ETF outflows, totaling over $158 million. Friends, consider the timing. It's December 20th, 2025, just days away from Christmas and New Year's. From a macroeconomic perspective, this is a critical period for institutions to lock in annual profits and settle their books. The fact that they are choosing to sell continuously at this time, rather than buying the dip, sends a clear message. In their view, the current price is not a value zone for accumulation, but a risk zone demanding an exit. Now, when we cross-reference this with on-chain data, things get even more interesting. Chart showing CEX outflows versus ETF outflows. We are seeing significant net outflows of coins from exchanges, which stands in stark contrast to the ETF outflows. What does this signify? This is a classic market divergence. It suggests that large entities and institutions are using ETFs and centralized exchanges to sell their bags to retail participants who are still active in the market. Meanwhile, another cohort of whales, possibly after conducting over-the-counter OTC deals, are having their buyers withdraw the coins to cold storage. This kind of internal conflict, where one hand sells while the other withdraws, is the strongest signal that any upward momentum is unsustainable. From a Wyckoff theory perspective, this perfectly aligns with the characteristics of a late-stage distribution phase, where composite operators use every market bounce to quietly and systematically offload their positions. Dimension 3. Technical analysis. Now let's look at the most direct evidence, the price chart. Please pull up the weekly chart. You can clearly see that the price remains pinned down by a critical long-term descending trend line, unable to achieve a meaningful breakout. Even more critically, look at the moving average system. The 20-week and 60-week moving averages have confirmed a death cross. In the Wyckoff trading framework, this is one of the core confirmation signals that the market structure has shifted from strong to weak, entering a bearish cycle. And please, pay attention to the volume. It's extremely anemic. Low volume consolidation within a downtrend is never a good sign. It's often the calm before the storm, preceding the next waterfall drop. Dimension 4. Order book and liquidity. Finally, let's zoom in with a microscope to the market's microstructure, the order book and liquidity heat maps. Look at this chart. Around the current price, the book is saturated with small retail buy and sell orders, indicating widespread confusion. But where is the real resistance? Look up towards the $90,000 level. There is a colossal wall of sell-side liquidity stacked up there. This means every attempt by the bulls to push higher will be met with ferocious selling pressure from the bears.
Now, look below. Where is the real whale support, the serious bid liquidity? It's sitting at $84,000. And if the price breaks below that level decisively, the area underneath it, all the way down to nearly $80,000, is a liquidity void. The order book is incredibly thin. What does this tell us? It tells us that whales have no interest in absorbing supply below the current range. They are waiting for lower, more attractive prices. This observation creates a perfectly coherent narrative when combined with our earlier analysis of systematic institutional selling via ETFs. Okay, to summarize all the evidence. On the macro front, we have institutions taking year-end profits. On the funding front, we have structural outflows from ETFs. On the technical front, we have a weekly death cross and trendline rejection. And in the microstructure, the order book shows immense overhead supply and fragile support below. Our final verdict for today is any price increase from here can only be defined as a relief rally within a broader downtrend. Its purpose is to retest the overhead resistance and value area, building up energy for the next, more violent leg down. The market is transitioning from a corrective phase to a confirmed downtrend. So, based on this thesis, how should we trade this? I'll give you specific trade advice using the MACD and ATR indicators. First, let's look at the daily ATR indicator. The ATR shows us that recent market volatility is decreasing, but the price's center of gravity is constantly shifting lower. This is a classic slow bleed. In this type of market, the worst thing you can do is FOMO into pumps and panic sell dumps. The ATR's value median is currently right around $88,000. Therefore, any rally that fails to decisively reclaim $90,000 should be viewed as a prime opportunity to build a short position, not a reason to go long. Second, let's look at the weekly MACD. From a very long-term perspective, the weekly MACD lines are still above the zero line with a positive slope. This does leave a glimmer of hope for a long-term bull market. However, friends, the future is not now. For our short-term trading strategy over the next 2 to 3 days, this long-term indicator is not particularly relevant and shouldn't guide our immediate actions. Therefore, my final strategic recommendation is, I do not recommend holding any long positions in the current price range. Opening a long now is like trying to jump up inside a falling elevator, extremely dangerous. Consider cautiously building a short position with no or low leverage. The optimal entry point would be on a rally towards the $89,000 area that shows signs of failure. The most critical risk management level. All short positions must have a hard stop loss set at $90,000. This level is the institutional sell wall and the invalidation point for our entire bearish thesis. If the price breaks through here with significant volume, our analysis is proven wrong, and we must exit the trade without hesitation. This analysis and strategy are valid for the next 2 to 3 days. Alright, that is our complete analysis for today. Remember, in a speculative market driven by narratives and emotions, data and logic are our only true north. If you found today's analysis helpful, please don't forget to hit the like button, subscribe, and turn on the notification bell so you won't miss our next critical market alert. I'll see you in the next video.